When the world feels chaotic, headlines are screaming about conflict, it's so easy to think your finances are just, at the mercy of it all. But what if you could build a financial fortress, a strategy that's actually designed to weather these kinds of storms? Well, today, we're going to break down exactly how to do that. Let's get right into it.
So let's kick things off with a quote that is, frankly, a bit of a wake-up call. The most important thing during war is not to keep all your money in banks. Whoa. Right away, this tells us we're not just talking about some market dips. We're talking about the possibility of the entire system we rely on coming under serious stress. It really forces you to rethink what financial safety even means. It's so easy to get caught up in the minute-by-minute market swings and the geopolitical drama. But the core argument we're exploring here is that the biggest threat to your wealth, it isn't actually what's on the news, it's how you react to it. The real battlefield, it's right inside your own head.
And this really gets to the heart of it. The market is going to do what the market is going to do. It goes up, it goes down. But the real damage, the permanent damage, is often self-inflicted. It's that moment of pure panic when you see red on the screen and just sell everything. That's when you lock in your losses. That's why keeping your cool is probably the single most important skill you can have in a crisis.
So, the very first rule has nothing to do with buying or selling a single thing. It's all about mastering your own psychology. Think of this as the foundation of your entire strategy. Before you can build a defensive portfolio, you have to build a defensive mindset, one that's calm, rational, and ready for the long game. And that mindset really boils down to these three core ideas. First, you have to avoid those gut reaction, emotional decisions. Second, you spread your risk around. You diversify, so no one single event can totally torpedo your finances. And third, you have to zoom out. Look at the big picture. History shows us again and again that markets do recover from crises. That long-term view, that is your most powerful weapon. Okay, so we've got our mindset fortified. Now let's talk about fortifying the portfolio itself. We're moving from the psychology to the actual strategy, looking at the specific assets that can act like financial shields in a storm.
And where do we begin? Well, with one of the oldest and most trusted assets in human history, gold. For literally centuries, when things get uncertain, people have flocked to gold. Let's dig into why.
Gold is what's known as a safe haven asset, and that's a perfect name for it. It's like a financial life raft. When the big ship of the stock market is getting tossed around in a hurricane, investors hop into the gold life raft to ride out the storm. Because it's a real, physical thing with the limited supply, it tends to hold its value, especially when paper currencies start to look a little shaky. Next up, we have the energy sector. Now this is fascinating because unlike gold, which is pretty much a pure defense play, energy can be both defensive and opportunistic when there's a conflict. It's a totally different tool for a very different job. The energy sector can act as what we call a price spike hedge. Look, we all feel that pain at the gas pump when a crisis hits and prices shoot up, right? Well, a price spike hedge is a way to be on the other side of that. By investing in energy companies, you could potentially benefit from the same supply chain disruptions that are causing those high prices, which can help offset the pain you're feeling everywhere else. All right, our third strategy here might make you scratch your head for a second. Investing internationally when there's a global conflict. I mean, why would you do that? It's a fair question, but the answer goes back to one of the most basic rules of investing: diversification. It's called geographic diversification. It's basically that old saying, don't put all your eggs in one basket, but applied to entire countries. See, if your whole portfolio is tied to just one nation's economy, you're really vulnerable if that country gets hit hard by a conflict. But if you spread your investments all over the world, and that's pretty easy to do these days with things like international ETFs, you're cushioning yourself from any one localized shock. And now we get to what might be the single most critical part of this entire defensive strategy: cash. We usually think of cash as just sitting on the sidelines, not really doing anything. But in a real crisis, it becomes your most important player on the field. It is your ultimate financial lifeline.
So, how much cash are we talking about? Well, the rule of thumb here is somewhere between 6 and 12 months of your essential living expenses. And you might think, wow, that's a lot. But think about it. In a major crisis, finding a new job or just waiting for the economy to get back on its feet could take a long, long time. This isn't money you're trying to grow. It's the money that's going to keep the lights on and food on the table no matter what.
And remember that quote from the very beginning about not keeping all your money in banks? This is exactly why. In a really severe crisis, it's not unheard of for governments to declare a bank holiday to stop everyone from pulling their money out at once, or they might put strict limits on how much you can withdraw. The point is, if a portion of your emergency fund is physically in your control, you're not totally dependent on the banking system to survive.
Okay, so where do you actually put this cash? Well, a mix of places is usually the smartest bet. Yeah, some of it you might want to have at home, in a safe or some other secure spot. The rest can be in what we call highly liquid accounts. Think money market funds or even a high yield savings account. Places where you can get your hands on the money in a day or two. The name of the game is quick, easy access.
All right, we've talked about the mindset, we've looked at all the individual pieces. So now let's see how this all clicks together and look at an example of what a fortified portfolio might actually look like.
So this chart gives you a really simple visual. Notice the balance here. We've got 30% in gold for that pure defense, 30% in the energy sector as that hedge against price spikes, another 30% in international stocks for diversification, and then holding it all up is that critical 10% in cash reserves, acting as the foundation for the whole thing. Now, and this is incredibly important, I have to be super clear, this is just an example. It's for educational purposes. Your personal situation, your age, your goals, how much risk you're comfortable with, all of that is going to change what the right mix is for you. Think of this as a blueprint, not a prescription. So let's do a quick recap of our financial survival guide. Number one, and most important, get your emotions in check. Then build that fortress. Keep your cash reserves strong. Use defensive assets like gold and strategic hedges like energy. Spread your risk by diversifying internationally. And please, never ever lose sight of the long term.
Look, if there's one thing history teaches us, it's that markets eventually recover. They always have. The real question isn't if they'll recover. It's will you still be in the game when they do? Is your portfolio, and more importantly, is your mindset built to endure that journey? That's the question you have to answer for yourself.